Mezzanine financing. What mezzanine debt is and how it's used. What is mezzanine financing? Mezzanine financing is a mixture of debt and equity financing that gives the loan specialist the option to switch the debt over completely to an equity interest in the organization in case of default, for the most part, after funding companies and other senior lenders are paid. In terms of risk, it exists between senior debt and equity. Mezzanine debt has implanted equity instruments, frequently known as warrants, appended, which increase the worth of the subordinated debt and permit more noteworthy flexibility while managing bondholders. Mezzanine financing is regularly associated with acquisitions and buyouts, for which it might be used to prioritize new owners in front of existing owners. In case of Chapter 11, KTAKEAWAYS, mezzanine financing is a way for companies to raise funds for specific projects or to help with an acquisition through a mixture of debt and equity financing. Mezzanine loaning is also used in mezzanine funds, which are pooled investments, similar to common funds, that offer mezzanine monetary to profoundly qualified businesses. This kind of financing can give more generous returns to investors contrasted with run-of-the-mill corporate debt, frequently paying somewhere in the range of 12% and 20% per year. Mezzanine loans are most generally used in the expansion of established companies, as opposed to as startup or beginning stage financing. Both mezzanine financing and favored equity are subject to being brought in and supplanted by lower interest financing, assuming the market interest rate drops significantly. How mezzanine financing works. Mezzanine financing bridges the hole among debt and equity financing, and is one of the highest risk forms of debt. It is senior to unadulterated equity, however subordinate to unadulterated debt. However, this means that it also offers some of the highest returns to investors in debt when contrasted with other debt types, as it frequently receives rates somewhere in the range of 12% and 20% each year, and sometimes as high as 30%. Mezzanine financing can be considered as pricey debt or less expensive equity, because mezzanine financing carries a higher interest rate than the senior debt that companies would otherwise get through their banks, however, is substantially less expensive than equity in terms of the general cost of capital. It is also less weakening of the organization's share esteem. Eventually, mezzanine financing permits a business to all the more capital and increase its returns on equity. Companies will go to mezzanine financing to subsidize specific development projects or to assist with acquisitions having short to medium-term time horizons. Frequently, these loans will be supported by the organization's drawn-out investors and existing funders of the organization's capital. In that case of favored equity, there is, as a result, no commitment to reimburse the cash gain through equity financing. Since there are no mandatory payments to be made, the organization has more fluid capital accessible to it for investing in the business. Indeed, a mezzanine credit requires just interest payments before maturity, and thus also leaves all the more free capital in the hands of the business proprietor. 1. Various characteristics are normal in the structuring of mezzanine loans, including mezzanine loans are subordinate to senior debt, however, have priority over both liked and normal stock. They convey better returns than customary debt. They are many times unsecured debts. There is no amortization of credit head. They might be structured with somewhat fixed, and to some extent variable interest rates. Mezzanine financing structure. Mezzanine financing exists in an organization's capital structure between its senior debt and its normal stock, as either subordinated debt, favored equity, or some blend of these two. The most widely recognized structure for mezzanine financing is unsecured subordinated debt. Sub-debt, as it is also called, is an unsecured bond or credit that ranks beneath additional senior loans or securities in its ability to guarantee against the organization's assets or earnings. On account of a borrower default, sub-debt holders are not paid out until all senior debt holders are settled completely. Unsecured sub-debt means that the debt is supported simply by the organization's promise to pay. At the end of the day, there is no lien or other credit that supports the debt. Other mezzanine debt is security by a lien on the hidden property and is consequently secured. Payments are usually made with regularly scheduled payments of debt service based on a fixed or drifting rate and the money owed at the maturity date. Favored equity, as opposed to being a credit that might be unsecured or secured by a lien, is an equity investment in a property claiming entity. It is by and large subordinate to contract loans, and any mezzanine loans get is senior to normal equity. It is by and large considered to be a higher risk than mezzanine debt because of increased risk and the absence of security. Payments are made through priority distributions before any distributions to holders of normal equity. Some investors haggle to get additional profit support. The chief is reimbursed at the stated recovery date, usually after that of mezzanine debt. The sponsor may sometimes haggle for an extension of this date. A favored equity investor may, however, have more extensive corporate endorsement rights, because it does not have moneylender liability issues. 1. Maturity, recovery, and transferability. Mezzanine financing normally matures in 5 years or more. However, the maturity date of some random issue of debt or equity is habitually subject to the scheduled maturities of existing debt in the issuer's financing structure. Favored equity by and large does not have a decent maturity date, yet might be called by the issuer as of some date after its issue. Reclamation is usually exercised to exploit lower market rates, to bring in, and once again, issue, debt, and equity at lower rates. By and large, the bank in mezzanine financing has the unrestricted right to transfer its advance. On the off chance that the credit involves future distributions or advances, the borrower might have the option to arrange a certified transferee standard as a limitation on the borrower's all correct to transfer. Favored equity, in contrast, is many times subject to restrictions or conditions on transferring the purchaser's interest in the entity. When all the favored equity has been contributed, the entity might permit transfers. Advantages and disadvantages of mezzanine financing. As with any complex monetary item or service, mezzanine financing has the two advantages and disadvantages to consider for the two lenders and borrowers. Advantages. Mezzanine financing might result in lenders or investors acquiring prompt equity in a business or obtaining warrants for purchasing equity sometime in the not-too-distant future. This may significantly increase an investor's pace of return. In addition, mezzanine financing providers are scheduled to get legally committed interest payments made month to month, quarterly, or every year. Borrowers lean toward mezzanine debt because the interest they pay is a duty-deductible business expense, thus substantially decreasing the genuine cost of the debt. Also, mezzanine financing is more reasonable than other debt structures because borrowers might move their interest to the equilibrium of the advance. On the off chance that a borrower can't make a scheduled interest installment, some or the interest might be all conceded. This choice is ordinarily inaccessible for different types of debt. In addition, rapidly expanding companies fill in esteem and may restructure mezzanine financing loans into one senior credit at a lower interest rate, saving on interest costs in the long haul. As an investor, the bank frequently receives a motivator and additional equity interest or choice to get such interest. Sometimes, on the off chance that the endeavor is profoundly successful, the little additional items can wind up massively important. Mezzanine debt also generates a lot higher pace of return, significant in what is still a low interest rate climate. Mezzanine debt also offers insured occasional payments in contrast to the potential however not insured dividends presented on favored equity. Disadvantages. While securing mezzanine financing, owners might sacrifice some control and upside potential because of the loss of equity. Lenders might have a drawn-out perspective and may insist on a board presence. Owners also pay more in interest the more extended the mezzanine financing is set up. Advance agreements will also frequently incorporate restrictive covenants, limiting the ability to get additional funds, or renegotiate senior debt, as well as establishing monetary ratios the borrower must meet. Restrictions on payouts to key employees, and even owners, are also normal. Mezzanine lenders are at risk of losing their investment in case of the liquidation of the getting organization. At the end of the day, when an organization goes out of business, the senior debt holders get compensated first, by selling the organization's assets. On the off chance that there are no assets staying, after the senior debt gets paid off, mezzanine lenders lose out. At last, mezzanine credit, debt, and equity can be tedious and burdensome to arrange and institute. Most such deals will require 3 to 6 months to finish the arrangement. At last, mezzanine credit, debt, and equity can be tedious and burdensome to arrange and institute. Most such deals will require 3 to 6 months to settle the arrangement. Pros: long-haul patient debt, less expensive than raising equity. Structural flexibility, no dilutive impact on organization's equity. Lenders watch out for long-haul. Cons: exorbitant interest rates. Debt is subordinated. Can be hard and slow to orchestrate. May remember restrictions for additional credit. Proprietor must relinquish some control. Illustration of mezzanine financing. In a mezzanine financing model, Bank XYZ provides organization ABC, a producer of surgical devices, with $15 million in a mezzanine credit financing. The financing supplanted a higher interest $10 million credit line, with additional great terms. Organization ABC acquired working capital to assist with carrying additional products to the market, and took care of a higher interest debt. Bank XYZ will gather 10% a year in interest payments, and will actually want to change the debt over completely to an equity stake in the event that the organization defaults. Bank XYZ was also ready to prohibit Organization ABC's acquiring of additional funds and to impose specific monetary proportion standards upon it. In a favored equity model, Organization 123 issues, Series B, 10% favored stock with a standard worth of $25 and liquidation worth of $500. The stock will deliver occasional dividends when funds are free until the characterized maturity is reached. The somewhat high liquidation esteem is a takeover defense, making it unprofitable to procure the stock for such purposes. As a general rule, mezzanine credit financing and favored equity are useful in various situations. Among these are recapitalization of an existing business, utilized buyouts to give financing to the purchasers, the board buyouts to permit the organization's ongoing administration to purchase out the ongoing owners of the organization, development capital for significant capital expenditures or construction of facilities, financing acquisitions, shareholder buyers, especially alluring to family-possessed businesses attempting to recapture control of shares that might have dropped none of the family's concern, to keep up with or increase family control of the business, refinancing of existing debt to take care of it or supplant it, asset report restructurings, especially by permitting time for mandatory repayments or no mandatory reimbursement by any means. Regularly asked questions. What is a mezzanine type credit? A mezzanine credit is a source of capital that is between less risky senior debt and higher risk equity with some of the features of both. Mezzanine loans are usually subordinated to senior debt or can be favored equity with a fixed rate coupon, or isolated. They may also have some type of cooperation rights, such as warrants, in the normal equity of the business, however in a way that will be undeniably less dilutive of ownership than the issuance of normal equity. Mezzanine loans are by and large quite expensive, but on the other hand, are patient debt, in that no payments toward the chief are expected preceding maturity. This patient attitude of the debt allows the business to develop toward the ability to reimburse the loans, and to increase its ability to convey more senior, and thusly less expensive debt. It is usually subordinated as well as unsecured. In the event that the borrower faces liquidity problems, it is possible to push a pause button on current interest payments for mezzanine debt, thus making the senior lenders safer in their safeguarded senior status. What is mezzanine financing in land? A land mezzanine credit is, by and large, used to pay for acquisitions or improvement projects. They are subordinate to senior debt within the entity's capital structure yet get priority over light and normal equity. Mezzanine span loans cover the cost of a purchase or improvement project that is not covered by senior debt. The loans are unsecured yet might be supplanted by equity in case of a default. Mezzanine financing allows the credit to increase the subsidizing without the ownership weakening that would be caused by the issuance of a significant measure of light or normal equity. Then again, land mezzanine loans show up as equity on the accounting report, which might make acquiring further financing somewhat easier. For the bank, land mezzanine loans offer extremely high rates of return. In a low interest rate climate, the opportunity to get some equity or control of the business, and, occasionally, the ability to apply some control to the operations of the business. How do mezzanine funds bring in cash? A mezzanine reserve is a pool of capital that seeks to invest in mezzanine finance for the purposes of acquisitions, development, recapitalization, and the executives, or utilized buyouts. Investors in a mezzanine store get a pace of return of 15 to 20% higher than presented on most forms of debt financing. As with all pooled investments, a mezzanine asset will bring in cash off the interest got on its pooled investments, as well as on profits from purchases and sales of various mezzanine financing instruments. Who provides mezzanine financing? Mezzanine debt is given by lenders, usually funds going in size from $100 million to more than $5 billion, specializing in such loans. They hope to create loans to companies that can safely service higher debt levels. An ideal debt supplier will offer a positive history of outcomes throughout the span of numerous years, and will actually want to offer references of previous transactions. The supplier should also be willing and ready to customize the debt structure to address a borrower's issues and plans. At long last, the ideal supplier will actually want to work to your greatest advantage, offering the best benefit for the sum, cost, and flexibility of the debt raised. Frequently, lenders have previously been engaged with the organization seeking the credit, and each has insight of the other's reliability and ability to understand the current business. Are mezzanine loans secured? Mezzanine debts can be secured on unsecured. Those used in land are frequently in a roundabout way secured, to some degree, by the borrower's land interests. It can be said that in corporate mezzanine financing, the debt is secured by the borrower's ownership interest in the organization, but since a mezzanine credit is genuinely wretched in the reimbursement schedule, this guarantee might be of limited esteem. Subordinated loans. Mezzanine debt normally has a lower priority than senior debts when borrowers fail. On the off chance that a business fails, it might have to sell assets like buildings and hardware to produce cash and pay off debts. In the event that there's insufficient cash to pay everyone, those creditors fall in line. Banks and senior bondholders are usually close to the front of the line, allowing them a superior opportunity of getting installment in a liquidation. Mezzanine loans are normally farther back in priority, despite the fact that they are above normal equity. Pros and cons of mezzanine loans for borrowers. Like each sort of acquiring, mezzanine loans accompany benefits and drawbacks for borrowers. Pros: access to capital, limit equity weakening, deductible interest payments, different reimbursement options. Benefits: capital structure. Cons: monetary consequences, risk of equity loss, shared control with lenders. Pros: made sense of. Access to capital: borrowers get the cash they need for a purchase or expansion. Limit equity weakening: instead of exchanging a substantial measure of equity for capital, borrowers can limit their equity weakening, while at the same time getting more than traditional banks need to loan. Deductible interest payments: interest payments might be deductible to the business. 3. Various reimbursement options. Borrowers might possibly pay interest charges with cash, add them to the credit balance, or give equity-like instruments to the moneylender. Benefits. Capital structure. Mezzanine financing frequently appears as equity on the accounting report, empowering borrowers to show lower debt levels and all the more easily meet all requirements for different types of financing. Cons. Made sense of. Monetary consequences. Influence is always risky. Borrowers might confront significant debts and different consequences in the event that things don't work out as arranged. Risk of equity loss. Assuming borrowers default on loans, they might need to give equity interests to lenders. 4. Shared control with lenders. Mezzanine lenders might set specific criteria that borrowers must keep up with. For instance, lenders could specify limits on monetary ratios or make other demands. 5. Pros and cons of mezzanine loans. For lenders, borrowers aren't the ones in particular who face benefits and drawbacks from mezzanine loans. This kind of loaning structure has pros and cons for lenders as well. Pros: interest pay, equity and interest. Cons: risk of default, low seniority. Pros made sense of. Interest pay. Mezzanine financing has moderately exorbitant interest rates to compensate lenders for the elevated degree of risk. Equity and cooperation. Lenders might possibly get equity, permitting them to partake in a business success. For instance, warrants might be important for the loan specialist's compensation, or lenders might get equity when borrowers default. 6. Cons made sense of. Risk of default. Lenders always risk losing cash to default, especially with mezzanine debt. Low seniority. These loans probably won't be secured by any physical insurance. For instance, there probably won't be liens on property, hardware, or other organization assets. 5. When the business pays senior debtors, it might drain any suitable funds before the mezzanine lenders get installment